Welcome back, you guys. This is Investor Forever here, and this is week 7. So, before anything else, I just want to say thank you all. Last week's video just crossed over 1,700 views in the first week. Now, for a channel that's got less than 50 subscribers and is only 7 weeks old, that's not a small thing to me. That means that people are really finding this content. They're watching it, they're sharing it, they're coming back. I see every comment, so I read every comment. And a couple of your comments in particular are actually driving part of today's episode. So we'll definitely get to that. But I just want to thank everybody who's watching these videos. It really means a lot to me. And I want to address something that happened directly that affects everyone that's using Fidelity as their financial hub, which at this point, if you've been following along, it might be you. If you've been a part of Fidelity for a while, you probably already know about this. We're pretty much at the end of it. But if you have a Fidelity account, you definitely need to hear this. So back in August of 2024, a cybersecurity attack breached Fidelity's internal computer networks. So the attackers gained access to customer data, including social security numbers, driver's license, and financial account information. The lawsuit also alleged that Fidelity detected the suspicious activity but waited almost 2 months before notifying any customers. And that delay is a significant part of what the legal action is about. So Fidelity has agreed to $2.5 million class action lawsuit. Approximately 77,000 people had their data directly compromised, but approximately 86,000 additional customers whose bank account and routing numbers were exposed may also be eligible. Now, to be clear, first, Fidelity denied all allegations of wrongdoing, but agreed to settle the matter. So this is common practice in this space. If you've ever saw or heard of any, data breaches, lawsuits, settlements, anything like that, it doesn't mean that Fidelity is an unsafe institution. I'm clearly still using them. I still think it's a good platform for this strategy. There are others, but this is the one that I chose. So a data breach in 2024 doesn't necessarily change my confidence in the platform in 2026. And this is the action item. If you're eligible, you can receive up to $5,000 for documented monetary losses related to the breach, or around $100 as a flat cash payment if you had no documented losses. You also get 2 years of identity theft protection and credit monitoring with $1 million in fraud insurance coverage. The deadline to claim is July 27, 2026. So you got this weekend to get that taken care of. The website is fidelitydatasettlement.com. I'll leave a link in the description for it. And go check if you're eligible. It takes 5 minutes and there's money on the table if you qualify. Do it before the 27th. On another note, let's put something into perspective. So most YouTube channels never see 1,500 views on a single video ever. And we did this in a week. And we're going to keep building because the content is real, the strategy is real, and real things compound. Now, I got 2 comments on this, but one stood out to me a little bit more than the other. So one viewer asked me about how margin works, and I'm going to answer your question in a little bit, brother. I got you. But there was one comment that came in before that I wanted to address directly because it's a legitimate concern, and a lot of people are probably thinking it, even if they didn't type it. So I'm going to post it right here. Yep, in all its glory. Yep, go ahead and read it. Soak it in. Yep, I had to. But I completely get where they're coming from. If I had no knowledge or experience in the market, then this would definitely be a major concern for me as well. And it's exactly the right thing to be thinking about. So let's answer these together, shall we? So first, let's address the margin part of it. So when the market drops significantly, the value of your portfolio is going to drop with it. And your margin buying power, let me show you actually. Yeah, so if you carry in a heavy margin balance during a severe downturn, you can get a margin call. And it basically, where Fidelity or whatever your brokerage is, whoever you with, they'll either force you to deposit more money or they'll sell your positions to cover the debt. And that's the real risk. That's basically the sharks coming to get their money. So here's how I manage that. I run conservative margin. Like I don't borrow 50% of my portfolio value. I also borrow short term if I even do borrow against it. So it's usually days, not even weeks. And I pay it back with my next income deposit. So the margin balance at any given time is small relative to the portfolio value. And that buffer is my protection against the margin call, even in a significant drawdown. And actually, come to think of it, I don't even think I've used my margin since I've opened this account. But it's basically like a credit card. Like, say this is how much you have in your account. This is how much they're willing to give you based on what you have. So you can do the calculations, divide it, do all that good stuff, figure out how much they're giving you versus how much you have, blah, blah, blah. And it's basically a credit card. If you go over 50%, what is it, like 10% on your credit card, that puts you into a different rating. 20% puts you into the next rating, and so on and so forth. So once you get to 50%, that's when, you know, in this, that's when you, I don't know if that's when you'll get a margin call, but look at it like a credit card. Don't carry that big of a balance, and you won't have that big of a bill in the end. But yeah, kind of think of it. I've never even used my margin. So my idle cash sits in SPACs, which is a government money market fund that pays around 3%. And when I spend out of the cash that's here, settled cash, when I spend out of that, a portion of it is sold to cover whatever I'm paying for. So I paid my phone bill out of here. I paid the water bill out of here. No, it's my internet. I haven't paid my phone bill yet out of here. But I'm still growing this account and learning it at the same time. So I'm in no way a financial advisor or anybody's financial advisor. Just because I'm on YouTube, Mama, we made it, doesn't make me a financial expert. I'm just a guy that's investing, learning as I go, and sharing along the way. But there's also a second layer of protection that I'm building now that I think is even more interesting, and that's put options. So in options trading, you got two main types of orders. You have a buy, which is known as a call, and you have a sell, which is a put. So think of it as like if you're buying something, you want it to increase in value, you're going to call up your friend and say, hey, this stock is going up. Or if it's a put option, you're selling the market, you're shorting, and you're putting it down. Think about it like that. You call up, you put down. So a put option basically gains value when the market goes down. So if I hold put options on SPY or SPX or either of the ETFs that I own, when the market drops 10, 15, 20%, those puts are going to go up in value at the same time my ETF positions are declining. So the put acts as insurance on the portfolio. So I think about it like homeowners insurance. You pay a premium, you hope you never need it, but in the event something bad happens, the payout protects what you built. And that's what puts do for a portfolio in a volatile market. Now, it's definitely not free protection. It costs money, is all options, and all of this stuff costs money. It's a money market. But in a market environment where volatility is real and margin is involved, the cost of a put is the cost of sleeping at night, and I'll take that trade all day. So just to add, since the start of 2020, the U.S. stock market, which is measured by the S&P 500, which is primarily what I trade in, I do a little bit of NASDAQ too. I do a little NAS 100. I do a little NAS, but with dividends reinvested, the market has grown roughly 151%. So from 2020 levels, you know what I'm talking about, from the demic low point, that's what we're going to call it, in March 2020, the broad market has more than tripled in value. So that said, it's all about time in the market, not timing the market. Now help me remember who said that. Put in a comment below who said that, because I forgot. I ain't even gonna lie. But downturns will happen, but history shows what happens over time, and that's all we have to go by. So I'm just leave y'all with that. But here's a deeper answer to the comment about market downturns. This is the one I really wanted to get to. So I wanted to answer your question too, bro. But this one right here, so this is where I want to get real with you, because this is deeper than just numbers on the phone screen for me. So the best hedge against a market crash isn't a financial instrument. It's not a put, it's not a call, it's not a four-legged creep or whatever option strategy you putting together. It's income. That's it. It's literally income. So if your financial picture depends on the stock market performing, then you're exposed. Your pants down. You know the rest. I don't want to get a strike on YouTube before this channel really blows up, but you get what I'm saying. If the market drops 30% and your only income is dividends from a portfolio that just lost a third of its value overnight, you in trouble. You done messed up, AA Ron. And that's why this channel has never been about just stocks. This is what I'm running right now. I'm still running Walmart Spark as a side gig, and don't sleep on that because it actually pays pretty good, or I wouldn't be doing it honestly. That income doesn't care about what the S&P did yesterday or what it's gonna do next week. And then I've got field inspections, or as I've been calling it on this channel, real estate photography, because all I'm really doing is just taking pictures of houses. But that's another income stream that operates completely independent of the market. I also do wholesaling, which is finding distressed properties, solving seller problems, and earning assignment fees for putting the two together. And this week, I joined the real estate team as a licensed agent in Georgia. So the last one is pretty big because joining this team gives me access to resale clients, buyers, and sellers that I wouldn't have found on my own. I've been focusing on the investor side. So now I get to learn from people who are already doing this side of the business at a high level. And I already have an open house tomorrow, which is the same day that this video is going to drop. So you're going to see this on Saturday. But so let's count these income streams here. We got Walmart Spark, field inspections, wholesaling, agent commissions, options trading, and dividends. That's 6 income streams, either active or in development, and none of them depend on each other. If the market crashed tomorrow, Spark still pays me every day. And if a wholesale deal falls through, then dividends will end up hitting. And if a slow real estate month happens, then I got options trading to fall back on. And that's the real hedge, not just puts or diversified ETFs, multiple and disconnected and independently functioning income streams all flowing into the same system. So I was always taught don't put all your eggs in one basket, not in stocks, not in income, not anywhere. So I hope that answered both questions and concerns. If y'all got any more questions, definitely drop your comments in the comments below, and I will be sure to get back to you. I check all comments and I'll do reply to every comment. I will say right now, we're a growing channel, and I'm trying not to. I don't want to overwhelm myself. We getting there. We getting there. I'm gonna get to everybody. Just be patient. Be patient. Speaking of options, though, let me walk you through what happened in the options account this week. So, as I stated here before, I used to day trade in the past, but I never really got past the occasional win here, win there, because I always had a 9 to 5 job, and it was kind of hard to do both. So, a lot of it also was fear of failure as well, and that stopped me from really going hard for real because I made a little money in options before. Then I switched to futures because the entries and exit was just a whole lot smoother. Just getting in and out of trades wasn't as complex as it is with options. And honestly, I'm thinking about going back to futures. So I've passed multiple prop firm challenges in the past, and I have an edge that's mechanical, and I'll be showing you why quality is better than quantity in just a few moments. So I'm currently running the 2 setups that I introduced last week, the 930 open range breakout and the previous day high and low break and retest. So this was the first trade right here. This was Monday morning. So I got the first 5 minutes of market open marked out here from 9:30 to 9:34. And then what we do is we sit back and wait. We drink coffee, we twiddle our thumbs, and we just sit there. And then what happens is the market goes up, comes down. So it breaks out of that 5 minute range, which is this green line here. It retests, and then it shoots back up. And then what we thought was going to happen was it was going to shoot up and hit our take profit, which it did not. So once it came down, I said, okay, maybe this is another retest. It kept going down, and I ended up losing this trade. So let's talk about why this failed. We didn't have a lot of momentum that got us over this previous high. So we broke out and then we retested, but we never broke above to show that buyer momentum. But the seller momentum was definitely there. And I entered at the bottom of that thinking that we were going to go back up, but price action said otherwise. You also could have looked at this in another way, seeing that the liquidity from London session, which I'm getting kind of technical now, was just taken, and then it quickly ran to the other side. So that's another strategy, but I didn't want to I wanted to stick to my strategy and not strategy hop. So I traded one strategy. I could have said, oh, okay, well, London high was taken. Let's see where it goes from here. Maybe it's going to take it and go to the other side, which it did. And that's the importance of having multiple strategies. But again, I was trading one strategy this week. So that was trade number one. I ended up losing about $10 on that trade. I didn't risk a lot at all. And now Tuesday, I ended up sitting this one out because I seen it was doing the same thing from Monday. And again, I was very tempted to jump in here, but I said I was trading this one strategy this week and I stuck to that. So I marked it out as if I were going to take it. I'm in 930 high and I did my 934 low. And at 935, I started looking. We broke below. And let me zoom in so you can actually see what happened here. So we ended up breaking below. We retested twice. And I said, okay, I probably would have entered about right here. So on the 952 candle, I marked my entry and said, okay, I would have got in right here. And what happened? It shot right the other way. And that was why I didn't take that trade, because I knew it was going to do the same thing. Well, you never know what it's going to do. I ain't going to sit here and lie to you and say I knew it was going to do that. I expected it to do that. And I might incorporate that strategy. Yeah, I'm leaning more towards futures. I'm finna go back to futures. But anyway, that was Tuesday morning. Now let's go to Wednesday. So Wednesday, I did trade this day. And I marked out my 930 low, my 934 high. And then if you look too, a lot of these lines correspond with other days. That's a conversation for another day. I'm gonna dig into that a little bit later. If y'all want more strategies on day trading, let me know in the comments below, and I might start doing some content around that. We're gonna see. I don't really want to be known as one of those guys, but I do want to help my community, because this can go for options trading. This can help you get better entries on just your typical stock purchases, your ETFs. Because they say the market is fractal. I don't even really know what that means, but it works on different charts. It works on a lot of different things. So 930, 934, boom. We got a break. We got a retest. I entered. It went straight to the take profit. This day, I think I won like $30. It was like $25 or $30 on that trade. And this was actually, if I had held it, oh, that's right. I pulled my entry, I pulled my take profit higher. So I wanted to see how high it was gonna go. But at a 2-to-1, which I did risk, this was a $30 trade. So if I had have held, which I forgot why I even had that marked out. I had something marked up here, but if I had a held, this could have easily been $100 day in less than an hour. And if I had even risked more, it could have been more than that. But this day, my strategy worked. And then I didn't trade Thursday, and Friday I didn't trade either, which was today. I typically don't trade on Fridays. If I am sitting at profit, say Thursday, I'm probably not going to trade Friday, because if I lose Friday and end up red because I traded on a Friday when I could have just stopped trading on Wednesday and Thursday and been net positive, I'm gonna be mad at myself all weekend. And I don't like to do that. I don't like to think about that. So if I'm winning, I'm out. I'm done. It's like a casino. Once you win, get out. And I'm not saying this is like betting. It kind of is, but at the same time, if you have a strategy and it works, then use it when it works. If it works, it works. If it doesn't, factor it in, study it, review it, journal it, do what you got to do, but master your craft. And that's why I've only traded one strategy this week. I saw a lot of different setups, but I only traded what I said I was going to trade. And I came out positive this week. So I won. So the discipline of not taking the bad setups is just important as taking the good ones, because the passes are where most traders lose money anyway. So the market will always offer you something. Your job is to take what meets your rules. And that's in day trading or general income investing, whatever your strategy is. So everything that the options income did this week, even the partials that I got, feeds directly back into the ETF portfolio. So the cash from the closed position goes either in JEPI or SPY. Somebody in the comments actually recommended some other stuff that I need to look into. So it's gold in these comments. Y'all check my comments too. Read my comments like I do, because it's stuff in here. We're a community now. Y'all family. So the trading account and the income portfolio are not separate systems. They're the same machine, just with different engines. All right, so on to the next. So quick update on Divider, because I know y'all been waiting on it. So the functionality is essentially built. It is very bare bones stock right now. Like, this is the stockest stock you can ever see. Now, it's made for mobile. I will put it like that. It's made for mobile, so cut your boy a break. Give me a break. But the percentage-based allocation, like the core engine of it, the dividend projection tool, I've got all of that set up. That's done. So what's taking time right now is making it look the way I want and integrating Plaid. So for those who don't know, Plaid is the technology that connects financial apps to your actual bank or brokerage account securely. And it's what makes apps like Robinhood, Acorns, all the stuff able to see your account balances without you manually entering them. So getting that integration right is what's going to make Divider actually useful rather than just another manual spreadsheet built with AI. But it's really bare bones, as you can see. But the Plaid integration is the financial technical piece. And when both of those land, we're launching. So my Investor Forever subscribers get free access. And this is not a marketing line. That's literally just a commitment that I'm making to you all for staying down and being loyal. So you've been watching this thing get built here in real time. So that's my treat to you. You get in first. So one more update before I close out. I'm recording this on a Friday night, and I have an open house tomorrow as a newly joined agent on my real estate team. So I want to be real about what joining a team means for this channel and for the strategy, because it's another income stream, but it's also an education. Working alongside experienced agents who have been closing retail transactions for years is going to accelerate my understanding of the retail business faster than anything I could have done on my own. And when that first commission check hits this Fidelity account, oh, that episode's gonna be crazy. So I'm definitely celebrating as well, since that'll be my first closing as an agent. So I got my license in March 2025. So if you're looking for an agent and you're in Georgia, definitely reach out to me via any of my social media. It's Investor Forever everywhere. I have two Instagrams. The other is Forever Homes ATL. All of those can be found in my link tree in my profile on YouTube, right here on my channel. And I'm a part of a team now. So you're not just getting me, but you're getting literally decades worth of experience. So definitely reach out. But a real estate commission flowing into a brokerage account that's also running options trades. I'm really thinking about going back to futures, but paying dividends, covering monthly expenses through margin once I get to that point. And I'm documenting all of this live. Like, that's what this channel is building towards. So the open house is tomorrow, but the grind don't stop for anything. I had to go ahead and put this video out. I just wanted to stop and make this video for y'all because I had some uploading issues the last couple of weeks. And my videos came out a little late, but I'm still on track. Let's keep this thing rolling. So that's week 7. 1,700 views. Thank you all genuinely. We talked about the Fidelity data breach settlement. Don't forget to file your claim before July 27th if you haven't already. Link is in the description. Market downturns got addressed, using puts as protection and income diversification as a real hedge. What else we talked about? We did an options recap and divider. Just got to get that Plaid integration and make it pretty. And yeah, I'm gonna go ahead and roll that out too. Next week, I might be showing some futures trading instead of options. Not even gonna lie. It'll be the same setup as far as entry management and close, but I think Fidelity's platform as far as executing orders and managing stop loss and take profits it was just a learning curve for me. But yeah, man, subscribe if you haven't and keep the comments coming. You all's comments this week drove an entire segment on this episode. Your questions will shape the content on this channel, so ask away. I'm enjoying growing this community with y'all, and y'all really got me looking forward to next week's video. I appreciate every single last one of y'all. Investor Forever, let's build.